Welcome back, everyone. Listen, if you're laser focused on building your wealth in today's modern economy, you are exactly where you need to be. Think about it. What if your next big source of income isn't a traditional 9-to-5 job and it's not a brick and mortar store, but just you, your laptop, a smart AI tool, and a solid Wi-Fi connection? Today, we are completely demystifying what happens to all that digital income under the brand new tax laws of 2026. All right, let's jump right in.
So the digital income economy is just exploding right now. To put that into perspective, vidIQ is actually reporting a massive 171% increase in views per hour just for the keyword digital income project. That is a wild spike in interest. But there's one glaring question that almost every single make money online tutorial just completely ignores. Once you actually start making that internet money, what exactly happens from an income tax perspective? Well, here is exactly how we're going to break it all down for you today. 1. The digital income boom. 2. Busting some major myths about online money. 3. Cracking the Section 58 rules. 4. TDS versus taxable income. And 5. Your ultimate 2026 tax checklist.
All right, part 1, the digital income boom. What are we actually talking about here? It's kind of funny, but digital income isn't actually a specific tax category in the law books. It's really just a broad umbrella term we use for revenue that's generated through technology. So we're talking about YouTube ad revenue, Instagram brand sponsorships, affiliate commissions, freelancing gigs on platforms like Upwork, AI-assisted consulting, and of course, e-commerce. It's this massive, vibrant ecosystem. But when it comes to taxes, it all boils down to the specific, actual nature of your day-to-day activity. Moving right along to part 2, myths of online money. Spoiler alert, it's definitely not tax-free. There is this super dangerous myth floating around that just because you make money on the internet, it's somehow invisible or totally exempt from taxes. That is absolutely false. Digital income might be flashy new wage income, but at the end of the day, it is still income. And here's the kicker. The new Income Tax Act of 2025 actually came into force on April 1st, 2026, and it entirely replaced the old 1961 Act. So if you're out there watching old tax videos on YouTube, they are quoting completely outdated laws. You gotta be careful with that. Which brings us to part 3, cracking the Section 58 rules and figuring out presumptive taxation. Okay, pay close attention to this one because folks get it wrong all the time. If your digital business qualifies for Section 58, the law gives you a presumptive computation based entirely on the nature of your receipts. It is 6% on your qualified turnover, which is usually money received through specified banking or electronic modes, or it's 8% on the remaining turnover. Please hear me out on this one. Notice the word or. We are absolutely not adding 6% and 8% together to get 14%. That's a huge misconception. You have to separate your receipts into categories and apply the percentage that matches. Let's put some real numbers to this so you can see exactly how the math plays out. Imagine a hypothetical digital business pulling in a total turnover of 50 lakh rupees. Let's say 40 lakh of that comes in through qualifying electronic modes. Well, 40 lakh times 6% gives you 2.40 lakh. Now, that remaining 10 lakh falls into the 8% bucket, which gives us 80,000. Add those two figures together, and your total presumptive profit under this specific mechanism is 3.20 lakh rupees. Simple enough, right? Now hit pause for a second, because this next part is absolutely crucial. That 3.20 lakh rupees, that is your presumptive profit. It is not your final tax bill. I can't stress that enough. 6% or 8% is not the income tax rate. It's just a flat percentage used to figure out what your business profit is. Your actual final tax liability is calculated totally separately, based on your overall taxable income and whatever tax slabs you happen to fall into. But wait, there is a catch here. Section 58 operates on a whichever is higher rule. What does that mean? Well, if our digital business has a presumptive income of 3.20 lakh, but the taxpayer turns around and claims that actual earned profit was, say, 5 lakh rupees, well, the higher figure wins. The law applies the higher number. So your calculation doesn't just automatically stop at the 6 or 8% mark. You would have to use that 5 lakh figure. We also really need to draw a hard line between business rules and specified professions. See, the Section 58 business category has a turnover limit of up to 2 to 3 crore rupees. But if you fall under specified professions, think along the lines of certain specialized IT professionals, the presumptive computation is generally 50% of your gross receipts, with a much lower limit of 50 to 75 lakh rupees. And a quick word of warning, just Just because you use a laptop to do your daily work, that doesn't automatically mean the law considers you a digital professional. It's the actual nature of the work you do that matters. All right, part 4, TDS versus taxable income. You really need to know the difference here. Because guess what? Not all digital income is treated the same way. Let's say a brand sends you a physical product instead of cash for a sponsorship deal. Well, under Section 393 of the new 2025 Act, there's actually a 10% TDS on qualifying business purposes. What about affiliate marketing? The law explicitly excludes commission-based businesses, which means you can't just blindly assume you get to use that ordinary 6% presumptive rule. And if you're an e-commerce seller, there's a very specific 0.1% TDS on qualifying sales. You literally have to look under the hood at the exact characteristics of every single income stream you have. And we really can't ignore the elephant in the room, AI. It is the fastest growing sector on the planet right now. People are printing money with AI-assisted content, design, and automation. But listen to me carefully. AI is an incredible tool, but it is not a tax loophole. If artificial intelligence is helping you generate business income, that underlying income still has to be properly classified, computed, and honestly reported to the government. No exceptions. Okay, here is maybe the biggest trap online earners fall straight into. They pull up their bank app, look at whatever amount was deposited that month, and they just report that as their income. But gross income and net bank credit are rarely the same number. If an e-commerce platform or a client overseas deducting TDS or platform fees before wiring you the money, your actual gross income is much higher than the net amount that hit your bank. And remember, tax deducted at source, TDS, is a tax credit mechanism. It's not your final tax liability. So, to save yourself a massive headache come tax season, I highly recommend setting up a 6-column monthly reconciliation sheet. Just track the platform you used, your gross revenue, the platform fees they skimmed off the top, the TDS or taxes withheld, your other expenses, and then finally, the net amount you actually received. Seriously, whether you're dealing with a local app or a massive foreign digital marketplace, taking 10 minutes to reconcile these numbers every month is going to save you. Do not wait until the night before the filing deadline to do this. And that leads us to our final segment, Part 5, the 2026 tax checklist to get you fully compliant.
First, let's do a quick recap of the 5 most dangerous mistakes you absolutely have to avoid. 1. Thinking your online income is somehow tax-free. 2. Reporting only your net bank credits instead of your actual gross receipts. 3. Blindly assuming every single digital business qualifies for that 6% presumptive tax. 4. Assuming affiliate commissions are treated the same as ordinary presumptive business. And 5. Relying on the old 1961 Act instead of making sure you're up to date with the laws for 2026.
All right, so here is your ultimate pre-filing checklist. Ready? First, identify every single digital income stream you have, no matter how small. Next, separate your business, professional, and commission-type receipts into their own buckets. Start tracking your gross receipts, not just what goes the bank. Reconcile your TDS meticulously every month. Always double-check your Section 58 eligibility and the specific rules before you try to apply. And lastly, make 100% sure that you and your accountant are actually applying the new Income Tax Act of 2025.
The internet and AI are completely changing how we work, right? But one thing hasn't changed a bit. Income still needs proper tax treatment. Earning the money is really only half the story. Reporting it the right way is what actually lets you keep it, invest it, and grow it. So I want to leave you with a thought to ponder today. Are you just asking yourself, how